Credit spreads has been my go-to strategy that allowed me to compound my wealth while I was working a 9 to 5. Personally, without learning how to trade credit spreads, I probably wouldn't have been able to quit my job and retire late last year. But I also know that credit spreads can seem daunting. They are an advanced option strategy. But if you learn the risk and you learn how to harness credit spreads, you can actually grow your account a lot faster than you thought was possible. So this is why I made this video today. I'm going to show you step by step how to trade credit spreads the right way, from beginner strategies to more advanced concepts that I use even today. This video did take me a long time to make, and I'm sharing with you years of experience all for free. So if you guys like content like this, make sure you guys like the video and subscribe to the channel. It'll really help me out, and it'll also let YouTube know that this is content worth watching. And before we get started, I'm gonna show you guys one of my larger accounts where I started trading credit spreads just so I can show you the performance for this video. So if you see right here, right, my account currently sitting around $740,000, give or take. And over the last 3 months, it's up 21%. And you can probably tell where I started selling credit spreads, right around the end of July to the beginning of August. And this is where the acceleration really happened. It's up $130,000 over this last 3 months. So not all 130 is attributed to credit spreads. Some of it is leap, some of it is stocks, some of it is selling puts, and some of it is credit spread. So in order to see the performance, I'm gonna bring you over to a dashboard that I use to track how I trade credit spreads. Here's every single trade that I took since I started this experiment to show you guys how to trade credit spreads. My first spread was in July that expired in August, and I lost on that one. You can see there's a decent amount of spreads here. UNH, EIX, Lockheed Martin, and recently more TSMC are the only 4 stocks that I've traded. You can see since the end of July, where I lost in my first trade, over the last 2 months, I'm actually up around $43,000. So just for context, in 2 months, I'm up $43,000, soon to be close to $50,000 because I have like 3 spreads that are almost all decayed out, planning to roll them very, very soon, which means that my actual performance over this last 2 months is close to 100%, which means I doubled my money in slightly more than 2 months. You'll see some metrics here that I use to track my trades. We will come back at a later part of this video to review some of these metrics so you guys can understand why these are important. If you trade credit spreads well, if you just follow a very simple strategy that we'll go through in this video in detail, understand your risks, and more importantly, how to minimize that risk, credit spreads really is a great tool to compound your earnings while you're working a 9 to 5. This video will be very comprehensive, so you may need to revisit this video many, many times. If you ever need to skip to a section or refer back to something, click on the chapter selection tool below. All right, let's get started. So what are credit spreads? Credit spreads is a defined loss and profit option strategy that involves simultaneously selling and buying an option on the same stock that expire at the same time. There are 2 main types of credit spreads: put credit spreads and call credit spreads. Generally speaking, a put credit spread means you think that the stock is going to go up, and call credit spreads means you think the stock is going to go down. Don't worry if that sounds a little complicated. We're going to go through a couple examples to really hone in the basics of what credit spreads are, and we're going to focus mainly on the put credit spread first because that's going to be the more widely used instrument, and then we'll come back to the call credit spread and also explain that briefly, but that'll be later on in the video. All credit spreads have 3 main parts, right? You have this underlying stock, you have the strike price, and you have days to expiration. So let's first take a look at put credit spreads by heading over to our trading platform. I'm using IBKR, but you can use Robinhood, Webull, Fidelity, Charles Schwab. They're all the same. And we're going to choose a stock first. For this demonstration, we're going to use Microsoft, and it's currently sitting at $510 at market close today. Next, we're going to go over to the option chain. This option chain will look the same regardless of what brokerage or what platform you're on. And it will tell you all the same information. It will tell you the days to expiration, how long before these options expire, as well as the calls and the puts, as well as the strike price. Now, for us, we're going to choose a day to expiration first. You can choose any of these, right? These extend pretty far out, but again, for simplicity's sake, we'll choose 13 days. And then we're going to start setting up our put credit spread. When we're selling a put credit spread, we are selling a put first that is below the current stock price of $510. And then we will be buying an option right below the one that we just sold. So in this case, because Microsoft's at 510, we'll sell our put option below that. So we'll be around 505. When we sell the 505, we will be collecting close to $455. Now we have to then buy the long leg, another put. So we'll buy it below 505, which is 500. Now, when we're buying an option, we will be spending money. And we'll be spending close to around $320 for this one option, which means that we'll net out around $120 of credit. And the reason that we are collecting money is because we are selling an option that is closer to 510, and we're buying an option that is further away from 510. So we'll be collecting more money because 505 is closer to 510, and we'll be spending less money on buying an option at 500 because it's further away from 510. After all that, we'll collect around $120 that will show up in our brokerage account immediately after we open up this credit spread. I want to focus your attention to this one thing here too. This is what we call a bid-ask spread. The bid is basically the maximum amount of money that you can maybe get. Highly unlikely you'll get 150 here. The ask is the minimum you'll get, the least you'll get, so 120. Usually speaking, you'll get somewhere around the mid price of 138 is the logical or the most reasonable number you'll see. But for demonstration purposes, we'll get the most conservative number, which is 120 in this example. Again, just to reiterate, the moment you open up this trade, you'll collect $120 in your brokerage account for you to use immediately afterwards. So now that we open up our first put credit spread, let's understand how we win and how we lose. There are three main outcomes for credit spreads. The best case scenario is if Microsoft stays above our 505 strike price. So in this case, if it stays above 510. What happens to both of these options is that they will both expire worthless after 13 days. That means they both go to zero. And we'll make our max profit of $120. Now, we're going to take a step back here. We're going to understand why both options, the short leg and the long leg, both are worthless. By first understanding what it actually means to sell an option and buy an option. When we buy a put, what that means is the buyer of that option has the right, but not the obligation, to sell a stock at a given strike price on or before the expiration date. When we sell a put, the seller has then the same obligation to buy those shares at the same given strike price on or before the expiration. So when we bought the 500 put, we had the right to sell our stock at 500. But Microsoft is at 510. So why would I want to sell my stock at 500 when I can go on the open market at that moment and sell it for 510? Making less, I would actually be better off not selling it at 500. And this is why those options are worth $0. The same logic applies. For the sold put at 505, I would have the obligation to buy 100 shares in Microsoft at 505. But why would someone sell me 100 shares of Microsoft at 505 when they could sell it at 510? That 505 put option that we sold is also worthless, and therefore it is also worth $0. So what we see is when both options expire out of the money, which means they are above our 505 strike price, above both legs, we make our max profit, which is going to be the credit that we collected, in this case, $120. Now, let's examine the second scenario, which is the worst case scenario, when both options expire in the money, which means that the stock price is below 500, our long leg. Because the stock price is now worth below 500, for example, let's say 495, as the buyer of the 500 put option, I now have the right to sell 100 shares of Microsoft at 500. Therefore, I will go ahead and sell those shares at 500. At the same time, the 505 put, we will be forced to buy 100 shares at 505 because someone sold it to us at 505, which means that we will be spending $50,500 acquiring 100 shares of Microsoft shares at 505 a share. At the same time, we will be selling those same shares at $500 a share, which means that we will end up losing $500 on this one transaction. We're selling at 500, but we bought it at 505. But before expiration, we also collected $120, right? So the final P&L for this one credit spread, if it were to go in the money, will be 500 minus 120, which means that we would be losing $380. And this is the worst case scenario. So our max loss will be 380. And let's talk about the third one. And this is the one that probably won't happen as often. And we will actually talk a little bit more about how to avoid this scenario. But there are certain times where the stock price goes in between your two strike prices. So for example, in this case, 503. If Microsoft were to be at 503, my 500 put option would be worthless, right? We've been over this, worth $0. But the 505 put option that we sold would be worth some money. At expiration, we would probably buy 100 shares of Microsoft at 505 a share, right? Again, we'll spend $50,500 to buy those 100 shares. But because now we own 100 shares, we can then sell it that same time at $503 a share, meaning that we will make back $50,300. So after all that, we'll lose $200 on that transaction. Again, remember, we collected $100 to begin with, which means that after all that, we'll net out a loss of $80. When it's in between our legs, again, it is directly related to how far in the money it is to our short leg, our sold put. At the end of the day, our P&L will look something like this, where we make the max profit when it's above our short leg. We will make the max loss when it's below our long leg. The break-even point will be our short leg subtracted by our total credit collected. In this scenario, will be $503.80. Anything above that will make money. Anything below that will lose money. Okay, so this is how the put credit spread scenario pans out. Again, I'll pause right here. If you guys have any questions, let me know down in the comment section below, and I'll do my best to clarify even further. Now, let's move on to the call credit spread side, and that will be exactly the same, only flip to the other side. So we're going to head back to Microsoft's option chain, and we'll do the exact same thing. So instead of selling it below our strike price, now because we're selling a call credit spread, we want to sell it above our stock price. So for example, we'll sell a 515 call option, and again, we'll be collecting money around $625. So in this case, now we want to buy another option above the one that we just sold. So let's do 520. Again, because we're selling an option closer to our stock price, closer to the money, we will be collecting more money, right? 625, and then we will be spending some money, a little bit less, to buy an option. This call option is now what we would call a protection leg, as you can see from the put credit spread example. The 520 call option, we will spend around $420 to buy it, and in this case, we'll net out around $190 of credit for a 515, 520 call credit spread. Let's do the same exercise. We will take a look at the three scenarios. One is both out of the money, both in the money, and only one leg in the money. So in this case, Microsoft, let's assume that it stays at 510, right? Now they're both out of the money because it's below our 515 strike price. If it's below 515, both options are worthless. Again, let's go back to the definition of what it means to sell a call and buy a call. So when we buy a call option, the buyer of that option has the right, but not the obligation, to buy 100 shares of that stock at the specified strike price on or before the expiration date. Now, when we're selling a call option, is the inverse. We have that same obligation then to sell 100 shares of that option at that designated strike price. If Microsoft is at 510 and my strike price is at 520 as the buyer of an option, there is no reason why I would want to buy 100 shares of Microsoft at 520 when I can go out and buy it at 510, right? I would be spending less money not going through with my option. Therefore, that's why the bought option is worthless. The same exact logic applies to the 515 put option that we sold. There's no reason why anyone would want to buy 100 shares of Microsoft from us at 515 when they can go out and buy it at 510. Again, that's why that option is worthless. So in this case, same thing as the put credit spread. Because they're both out of the money, we would take our max profit, which is the credit that we collected when we opened up this credit spread, which would be $190. Now let's examine the second scenario, which is where they're both in the money. So they're both in the money when the stock price goes past both of our strikes. So it goes past our short leg and our long leg. So in this case, let's assume that Microsoft goes to 550. So we would have to buy 100 shares of Microsoft at 520, spending $52,000 to buy 100 shares. But then our sold call, we can then sell that 100 shares at $515 a share, which means that we would make back $51,500. It nets out to a loss of $500. What you see here, same thing with the put credit spread, is that it will be the difference between our legs, which would be 520 minus 515 times 100 shares. Therefore, the loss here will be $500. Again, we collected $190 initially up front, which means that we would only end up losing $310 if both options are in the money. This is, again, our worst case scenario. Let's talk about scenario number 3 then, when it's in the money. In this case, let's assume that Microsoft is just slightly in the money. $516 is the final strike price. The 520 call option that we bought will expire out of the money, like we talked about earlier. The 515 strike price that we sold, we would be in the money. So what would happen here is we would have the obligation, right, to sell 100 shares, but we don't have those shares. So what we do is we go onto the open market, we'll buy 100 shares at $516 a share, which means we'll spend $51,600, and then we would then sell those shares immediately afterwards at $515 a share, getting back $51,500, netting out, again, $100. So a very easy way to remember it is just remember your stock price minus your strike price, which is 515, times 100 shares, there'll be $100. Now, because we collected $190 initially, we actually end up making $90 on this trade. And that is because our break-even price is going to be $515 plus $1.90, which would be $516.90. Anything below $516.90, like in this case $516, will end up making money. Anything above $516.90, like $519, will end up losing money. That $516.90 is our break-even point. So you can see from the chart that anything below our short leg, 515, is going to be our max profit. Anything above 520, which is our protection leg, will be our max loss, and anything below our break-even point will make money, and anything above our break-even point will lose money. So just to reiterate, on the put credit spread and call credit spread, we sell an option closer to the money, and then we buy an option further away from money, which we'll call the long leg. That long leg is our protection leg, and that's the difference between selling a naked put versus a credit spread, because that bought option, that long option, will allow us to minimize our risk to whatever that width is. Okay. Again, if you guys have any questions, let me down in the comment section below, but we still have more to talk about, so let's get to it. So now that we know how to put and call credit spread works, let's take a look at how pricing changes as the underlying stock moves up or down. We're only going to do a put credit spread example here, but you can imagine on the call side, it's going to be exactly the same thing, only flipped to the other side. So I want to take one of my actual trades that I traded earlier this year to demonstrate this principle. So earlier this year, we sold a 395 put credit spread on Microsoft, 31 days out, and collected a total of $132 of total credit. So during this time, Microsoft started at 421 and got to a low of 394, but it ended up out of the money at 414. That as the stock dips around August 5th, our credit spread pricing peaked around $250. Our P&L at that point in time will be negative $100 because we collected $130, but the credit spread was worth $230. I think it's a little important for us to understand why at this very moment the credit spread isn't worth $500, even though both legs are in the money. Because there's still 25 days left, so Microsoft still has a chance to be out of the money before expiration. And as you can see, as soon as Microsoft rebounds and goes above 400, the profit on this credit spread trade turned positive. And this is because of the concept called theta decay. Theta is how much a contract decays or loses value each and every day, which means that the options contracts that we sold and bought will be worth less and less each and every day. And then we as option sellers, because credit spread is an option selling strategy, will end up making money as these options become more and more worthless. After Microsoft recovered and went above both legs, the rest of the trade is relatively uneventful, with Microsoft ending at 414. Which means that Microsoft doesn't even have to go up, and we can still make max profit. In this case, still return 36% a month. And this is exactly why credit spreads are great for small accounts, because you actually don't need that much money to run the strategy, and why it's great for people with full-time jobs or working professionals, because it's actually pretty hands-off and can be pretty passive. So now that we examined a winning trade, now let's look at a losing trade, because we're not going to win every single trade that we take. So we're going to use the same time frame for Microsoft, but instead of selling it at 400 and 395, we're going to be selling it basically at the money at 420, 415. Microsoft again was at 421. With this increased risk, because we're closer to the money, we collected $225 a spread. And as you can see again, Microsoft dipped all the way down to 414 on August 5th. And at that point, our spreads are worth actually $410, a lot more than our previous example. And the reason for that is because 394 is really in the money. Our bottom leg is at 415. And the market is pricing in that it's going to be a lot harder for Microsoft to get back above 420. Then you can see Microsoft recovered, ended up at 414, which means that it is in the money on both our sold leg and our bought leg. And then we will then be forced to take the max loss of $275, which would be 500 minus 225. The beauty here is that your losses are defined, right? You're only risking $275, our max loss, to make $225, which is our max profit. I'm going to compare a credit spread to selling a single put. So here we have an AMD, and we sold a 200, 195 put credit spread basically right at the money again. At the same time, we also sold a 200 put unprotected. So for the 200, 195 credit spread, we collected $230. For the unprotected put, we collected $1,170. But as you can see, AMD fell all the way down to $163. For our credit spread, we are limited by our max loss no matter what the price point of AMD is. AMD can be $195, it could be $163. We are going to lose $270. And we'll talk a little bit more about this later on, but this is one of the benefits to selling credit spreads because your losses are defined, as we said earlier on in this video. For the unprotected put, we'll end up losing more and more and more money the further AMD falls in the money. And so when it gets to expiration at $163, that unprotected put will end up losing us $2,492. So if AMD were to continue to go down, for example, maybe to 153, then we'll lose another $1,000, which means we'll end up losing $3,492. So let's just compare apples to apples, right? Let's sell 5 credit spreads to match the same amount of credit we will receive from selling that 200 unprotected put. Even if we were to sell 5 credit spreads and end up taking the max loss, we would still end up only losing $1,350, which is still more than $1,000 less than if you were to sell that one standalone put. Again, I want to really reiterate this point. The beauty of credit spreads is because we are buying that extra leg as protection, our losses are always going to be defined, which makes it really easy for us to understand our risk to reward. So let's move on to a beginner strategy on how to open up and trade credit spreads. So credit spreads have 4 variables that we need to learn about. First one is days to expiration. Second one is the strike price that we sell it at. Third is the width between our 2 strike prices. And the fourth one is the underlying stock that we're selling our credit spreads on. So let's now focus first on time to expiration. How many days out we want to sell our credit spreads for? Here we charted out Tesla's 270, 265 put credit spread, the price point at different days to expiry. So the one that is at 70 days out is going to be worth around $160. The same credit spread, but with 10 days left to expiry, will be around $50. The more time there is on the spreads, the more credit we can collect because those options are going to be worth more. What I would actually want you to focus on is actually focus on the curve. Do you see how the curve starts accelerating downwards around 30 to 40 days to expiry? While before 40, the value of that contract actually doesn't change too much. It goes from 160 to maybe 130, only lost $40. But in a span of 10 days, it goes from like 130 all the way down to 100. So it's actually lost the same amount of value in less time. And this is the perfect example to demonstrate what we call theta decay and how it speeds up as it enters into the 30 to 45 day zone. And then it really accelerates when it gets to around 2 weeks left. So what we want to do here, and the lesson and takeaway here, is that we want to sell credit spreads around 30 to 40 days out to take advantage of this acceleration in theta decay. Anything further out beyond 45 days, thinking 65 or 70 days, quote unquote, be wasting time because the value of those contracts are not decaying out as fast as it could be if we sold a little bit closer to expiration. So I'll give you an example. 29 days left to expiry, Tesla's worth $115. At 71 days to expiry, that Tesla credit spread is actually worth $167. So I would rather sell two 29 days to expiry credit spreads than to sell one 71 day to expiry, because I would collect 230 if I sold two 29 days to expiry, as opposed to selling one 71 days to expiry for 167. So going forward, especially for this beginner strategy, we are going to be selling around 30 days to expiration credit spreads, because that is where we are optimizing theta decay. So now let's move on to the next variable, which is the strike price. Closer that our credit spreads are to the actual stock price, the more money that we're going to make. In one example, we sold the 420, 415 credit spread by selling the 420 put and then by buying the 415 put. For this one credit spread, in this scenario, 23 days out on Microsoft, we're going to collect around $160. It's probably going to be slightly more just due to how the bid-ask spread works. And you just remember this number at the bottom of the screen right here, probability of profit. The probability of profit, otherwise known as POP, is 60%, slightly out of the money. Microsoft only has to drop 1% for us to be in the money. If you want to decrease the risk and increase the probability of winning, we will move further out of the money by selling further away. Sell the 415 and we will buy the 410. And you can see the probability of profit went from 60% to 69%, and the amount of credit dropped from 130 to 115. We can do the same exercise again by going further out of the money, by selling the 410 and then buying the 405. You can see the probability of profit went further up at 76%, and now we're only going to collect $76 on the spread. Inverse relationship between credit and probability of profit. The higher the chance of you guys winning, the less credit you're going to collect. So what exactly is POP? POP stands for probability of profit, which is what the brokerage thinks is the chance of you winning and making a profit on this trade. You might also hear delta. It is usually used as an approximation for probability of profit. So for beginners, it's okay to equate delta to POP. So the next logical question is, what is a good POP for us to be selling credit spreads on? If you see my put selling masterclass, it's going to be a very similar explanation. When I first started, and I would recommend this to most beginners as well, is that you choose a delta or a POP that is between 70 and 80%. The reason for that is because a normal distributed bell curve covers about one standard deviation when it's between 70 and 80%. So statistically speaking, it's a relatively conservative choice. Now, later on in this video, we will look at ways to try and optimize the strike price, but for beginners, it is okay for us to use probability of profit or delta as a good way to find a relevant strike price for us to enter. So going back to our previous example, you can see a POP of around 76% will net you close to $93 on that one 5-point credit spread. So for simplicity's sake, we'll just say it averages out to $100 of credit, which means that you would take $100 of profit divided by your max loss, which is going to be $400, and your total return on risk will be 25%. In 23 days, you'll be making 25% if Microsoft stayed above 410. And so that's a really good return, and that's also another reason why credit spreads are great to compound smaller accounts. Now that we understand how to choose a relevant strike price for beginners, so now let's take a look at what the width between our top leg and our bottom leg should be when we're selling either a call or a put credit spread. So in this case, right, we're selling a 410, 405 put credit spread. It's a 5-point width. The return on investment here is 76 divided by 422. So it's around 18%. Now, what will happen if we were to widen this to a 10-point spread as opposed to a 5-point spread? So we would still sell the 410, but now we're going to buy the 400. And for this one spread, we're now going to collect $104 for this 10-point spread. Credit has actually increased, but so has our max loss. 104 divided by 896, which would be 11.6%. So you can see the wider the width, the more credit you're going to collect, but the actual return on investment will actually drop. So what I would recommend, especially for beginners, is to keep those legs, those width, as short as possible. So on Microsoft, for example, you see the shortest width possible was a 5-point width. That's what we're going to go with. Because what I would rather do is sell 2 5-point spreads as opposed to 1 10-point spread and collect 76 times 2, which is $152, as opposed to selling 1 10-point spread and collecting $104. I will make more money selling those 2 5-point spreads. So now that we know what width to choose for our credit spreads, let's move on to the next one, which is the underlying stock. For simplicity's sake, what we care about when we're choosing a stock to sell credit spreads on, liquidity and volatility. We're going to focus mainly on volatility because that is going to have the largest impact on the amount of credit that we can collect when we're selling either a call or a put credit spread. And we're going to show that by comparing 2 stocks with 2 very different implied volatilities. So here is a 5-point spread on Microsoft right at the money, 420, 415. Now, if you were to compare this spread to, let's take a look at something like Tesla. Tesla's at 328. Let's do the same expiry, 23 days out. Or sell it slightly out of the money, 320 and 315. We can actually collect more money here, 185, than the previous example with Microsoft, even though the same 5-point spread, and our spreads are actually further away from the current stock price at Tesla. Even if I were to drop it further out of the money, you can see I still collect around 160, even though we're about 12 points away from the stock price. And one of the main reasons for that is what we would call implied volatility. The higher the implied volatility, the more credit you can collect from your credit spreads. So you can see IV here for Tesla is around 61%. And then for Microsoft, it's around 18%. So now that we understand generally how these variables affect credit spreads, let's try and open up a credit spread live. What we're going to do first is we're going to try and figure out a good stock to sell. And like we said, we need to find stuff with high volatility and high liquidity. So most brokerages have what we call screeners where we can put in these 2 main criteria and filter for stocks that fulfill what we're looking for. I already have this set up, but I'm really only filtering for 2 main things: option implied volatility and option volume. If you guys want to go in here and add your own filters, additional filters, or change the one I have in here, this is where you would go and select the ones that you think are relevant. So let's just start off with option implied volatility. Usually speaking, we want to be aiming around 30 to 55%. Anything above 55, it's very volatile. There's going to be a lot of price fluctuations. So especially if you're a beginner, that price fluctuation may be hard to handle. And so I would just recommend that you don't do anything that's too volatile because it could cause a lot of emotional distress. We'll talk more about the psychological part of trading later on. Anything below 30, kind of like what we saw with Microsoft, it may not be worth your time because you can be getting a lot more bang for your buck selling something else. So sweet spot 30 to 55%. One caveat here, IBKR actually does a really weird way of setting limits. So you have like 0.02 and 0.04. Basically what that means is you're looking around 30% to at most 55% implied volatility here. Next thing we're going to focus on is option volume. Option volume basically just means how many options have changed hands within a certain amount of time. We want something that's relatively liquid, right? Highly traded, because as you'll see later on this video, we have to think about the worst case scenario, which is being able to get in and out of a trade relatively quickly and unscathed when you have to take a loss. I'm going to try anything above 100K and above volume. So you can see this is what it screens out to. I'm filtering by market cap right now. You see NVIDIA, Amazon, Meta, Broadcom, Google, TSM, another Google, Oracle, Netflix, Alibaba, Palantir, United Healthcare. You can see some obvious ones that are left out, like Microsoft's not here, Apple was not here, mainly because their options implied volatility is very, very low. So now that we found one here, we can try and trade a credit spread on any of these. So for simplicity's sake, let's just do NVIDIA. We'll click on it and we will go to the option chain like we did last time. So what do we do here? We want to trade for 30 days out. So we'll click on the 32-day expiry. And then what we're going to do here, we're going to be looking for, again, 70 to 80% probability of profit for our strike prices. That's around 76. That's perfect. So 170, 165 will be our probability of profit. If you want to be a little bit more aggressive, be at like 68, that's a little bit aggressive. It's past our range. If you want to be a little bit less aggressive, you're at 83. It's a little bit, I guess, too conservative. So in this case, 170, 165 is the sweet spot, right? Collect close to $100 on this one spread. Bid ask spread is 98 to 106. So you can see the bid ask spread is very short because there's enough liquidity here. So you're probably going to get around $102 on this one trade. You just click in here and you go find your actual number. Let's just say we're selling 20 here, and then you can up the price here to I usually go around the mid price, so 102. And then you say buy order. So one thing you want to realize here, you're taking a credit because it is a credit spread, so you're taking money in. Just to reiterate, if it's above 170 on October 31st, you will make max profit. If it's below 165, you would take the max loss. Let's do one more about opening up a call credit spread. So we'll go back to research, go back to market screeners, and it's very simple. So let's choose one with really high option volume. We'll go to, well, NVIDIA has the highest option volume, so we can go, like, for example, let's do the friend AMD. AMD's implied volatility is 46.6 with 500,000 shares of options. So we'll go to options here. And we'll do basically the same thing. We'll find the 32-day DTE. And instead of selling a put credit spread, we will now be selling a call credit spread. So maybe we start with 167.5 and then 170. Probability of profit 60, 67, 75. Perfect. The first thing you can see right here is that the width is actually 2.5 points instead of 5, so we want to be selling the shortest width possible. You can kind of tell the liquidity isn't as high as NVIDIA, so you can see your bid-ask spread is slightly larger. But we're still going to try and aim for the mid price of $52. So we'll go in and we will say order. And let's go again, same thing as 20. Credit, we'll go to the mid price, which is around 53. And then we will say buy order. And then after clicking buy order, the order get placed, and then you might have to readjust your pricing in order for it to get filled. The same exact idea on the put credit spread side, on the call credit spread, at least in the beginner strategy. In the more advanced section later on in this video, we will talk more about how to sell calls, because selling calls, in my honest opinion, is a little bit harder than selling puts, mainly because the market is generally in an upswing most of the times. We've opened up two credit spreads, a put credit spread and a call credit spread. We understand what DTEs are, what the right widths are, what the right strike prices are, so you can theoretically go out there and sell your first credit spread. Okay, so on this channel, we like to talk risks. So let's talk a little bit about the pros and cons of credit spread. But we're really going to focus on the cons here, because in the advanced section, we're going to take these cons, these weaknesses, and try to cover them up. So the benefit is probably, hopefully, pretty obvious. You have a high probability of winning. You can make a decent return every single month. You don't need a lot of money to do this. And lastly, it's actually relatively passive, and it can be pretty straightforward, which makes this ultimately a great strategy, again, for people with small accounts and people with full-time jobs that have other commitments. However, there are a couple of cons. The first one is probably the easiest to understand. In most cases, because we're selling credit spreads out of the money, we can lose more money than we can make. In all of the examples that we shared, those are all out of the money examples, which means that we are collecting less credit. Our max profit is always less than our max loss. It is not unlikely that you take a couple of bad trades, you lose the max loss, and it wipes out your account. That is one of the biggest drawbacks to a selling option strategy, because you will usually have a larger max loss, a larger drawdown, than you do a max profit or your upside. And number two, credit spreads and selling puts are two very different strategies, and they have two very different ideologies. The first one is that when you're selling puts, you can see that even if you get assigned, you will have shares to hold on to. So your consolation price is you'll have shares, 100 shares of something. However, when you're selling credit spreads, you don't really have that luxury. You're basically trading that safety net of having shares for increased gains. If you guys haven't seen my put selling masterclass, I'll link it in the upper right-hand corner here. But essentially, when we're selling puts, we are acquiring stocks. When we're selling credit spreads, we are trading. And so because of that, we have to have two very different mentalities. When we're trading, we are actually actively managing our profit and loss, because there is no consolation price, right? We can't have shares as a fallback, which means that a lot of times credit spreads can actually be more difficult to trade, and usually is more difficult to trade than selling puts, because there's an emotional aspect to this. Which takes us to the most important and probably the most interesting part of this video, which is talking about the psychology behind trading. The real reason that most traders lose isn't because they don't understand the concepts that we're going to talk about. It's because they're not able to follow a plan consistently because they don't know how to control their emotions, right? If a trade goes red, they panic. If a trade goes green, they get greedy. And if you're not able to control it, then you're still going to lose in the long run. And there's actually a lot of behavioral research that kind of explains a lot of our human behavior. In 1979, there's two psychologists, Daniel Kahneman and Amos Tversky. They introduced a concept called prospect theory. And in this theory, they introduced loss aversion, which is humans feel the pain of a loss 2 times as much as the joy from winning. So an example is a $100 loss hits you twice as hard as a $100 gain. And for me, that's 100% true, right? I can't tell you a lot of the wins that I've had, but I can tell you a lot of the losses that have just stuck with me and gnawed at me for years. And that combined with something called disposition effect, identified by 2 researchers, Scherfrin, I might be pronouncing that wrong, and Statman, which describes the behavior that I think we as investors or traders are pretty familiar with, which is holding our losers way too long and then cutting our winners way too quickly. And I honestly think that as option sellers, these 2 behaviors, loss aversion and disposition effect, they're amplified because the people who gravitate towards selling options are people who are actually more risk averse. I'm actually extremely risk averse. So when I first started, the reason that selling credit spreads resonated so much with me is because someone's telling me that I can win most of the time and at the same time is relatively passive and I can make decent amount of money by doing so. That sounds great. When we win a lot, we are not accustomed to losing. And so when we do lose, I actually think this loss aversion hits us even harder than maybe 2 times. Right? We just don't want to lose. We don't want to realize that loss. And so we have the disposition, right, to hold onto our losers for as long as possible because we don't want to realize the pain of losing. And so what we end up doing is we start rolling it out. We start spending money to roll it out, to delay the inevitable, right? Hoping that one day the market will rebound and our trade will become green so that we don't actually have to be wrong. From my experience, this is extraordinarily true. The worst losses that I ever had in credit spreads are the ones where I keep trying to hold on and not take the actual loss by rolling things out and hoping that the market recovers in my favor. And I'm rationalizing these emotional responses. And this is how my small losses became very, very big ones. Let me know down in the comment section below if you've ever had experiences like this. And this is why our advanced strategy came about, right? These are all from my losses that I've taken over the years to try and minimize the effect that fear and greed have on me. And so what we're learning on later on in this video is all from controlling these psychological impulses. So keep that in the back of your mind when you're going through the rest of the section, because I think it's going to put things in a lot of context for you to understand why I trade the way that I do. So let's get to the more advanced section by first understanding what a bad trader looks like and what a good trader looks like. So let's head on over to our iPad and we'll just do some simple profit and loss analysis. So let's assume that every time we win, we make $100, and every time we lose, let's say we lose the max loss of 400, right? So maybe in this case, we win, let's say 7 times, but we lose 3 times, right? So you see here we'll make, here we'll make $700, but we'll lose $1,200 when we lose, which means that we'll lose $500 overall, right? So that's not a very good risk to reward because every time we lose so much, but we're winning a lot. We're winning 70% of the time, but overall we turn out negative. So this is why the previous strategy sort of works. We'll take a win of $120 and we lose the max loss of $380. So it's around a 80% win rate. So let's say we win 4 times and we lose 1 time. So this comes out to be 480 and this comes out to be 380, which means that on average we'll make $100. $100, right? Profit over a span of 5 trades. Why? Because we're winning enough to cover up this one loss. So what we ideally want to do, especially as we get into the more advanced section, is we want to make sure that when we win, we can take as much as of the max profit as possible, and that when we lose, we don't lose nearly as much as the max loss, because that is how one trade wipes us out, right? Even in this scenario, this one trade basically took more than 75% of our total gain on this one loss. And this is true for everything with trading. Doesn't matter if it's credit spread, doesn't matter if you're trading leaps or day trading. How you manage losers is going to be the most important thing. Because I'm going to do one last example to show you that ideally speaking, if you're able to reach this level, you'll be profitable in the long term. What I'm doing nowadays is this. I win. Maybe I win a little bit less. I keep the same win, right? But when I lose, I only lose, let's say 60. I get out really, really, really quickly. So what happens is, let's assume that I just win 5 times and I lose 5 times. My win rate is terrible, right? I only win 50% of the time, which is pretty bad when it comes to option selling. What you'll see is you'll end up making $600 here. You'll end up losing $300 here. So you'll make a total of $300 after a span of 10 trades. But ideally speaking, if you're really good at trading credit spreads, this is probably what your P&L is going to look like. And I'll show you guys my results for over the last 2 months or so you can see that this is actually doable. On the channel, I show you the implementation of the trades and the results, because that's how you guys know you guys can trust the process and trust the results. So make sure you guys stay around for that. Ideally speaking, what you want to do is let's assume that we keep the same win-loss, right, of 120 and 60, but we want to try and win 7 and try to lose 3, which means that this will end up being 840 and this will end up being 180. Okay, which means that you'll net out $660 after 10 trades. This is what we're looking for. And after the more advanced section of the video, or if you stick around and gain more and more experience and you tinker my strategy to how you guys like to trade, you guys will be able to get here. I have no doubt about it. I know from experience that when you're selling options, it is very hard for you to want to take a loss because the chances of you winning are so high. All right, so let's move on to the more advanced section, which is going to be about how we up that win rate as much as we can. And then more importantly, how we up the average credit collected. And then most importantly, and this is hopefully the takeaway, is how we manage those losers when they do show up. So now that we understand why we need to manage losses, let's introduce the concept of setting up stop losses, which basically means that if something hits a specific price, then I exit the trade and I take the loss and I move on. So in our case, the number one rule when it comes to selling credit spreads for me is that I am never willing to risk more than I can make. In simple terms, is if I have a credit spread, a call credit spread, and it gave me $100 of credit, I'm not willing to lose more than an additional $100, which basically means I'm risking $100 to make 100. So in application, how this would work out is if my current credit spread is worth $100, if the credit spread hits 200, then I would take that loss of $200 and exit the trade. But because I already got $100 up front, my final loss is only going to be $100. This shows you, right? I'm not willing to lose more than I can make. If the credit spread hits 150, never hits 200, I don't exit. If the call credit spread hits 175, I don't exit. The moment it hits 200, I'm out. By setting up this initial stop loss, right, we're already getting rid of the possibility of losing a large sum of money. For example, $400 in this case. We're getting rid of that possibility so that we can maintain our P&L, right? Because like we said earlier, if I lose $400, I need to win 4 trades in a row to make that money back. Second rule is that we never let a winning trade become a losing trade. What that means is if my trade starts going in my favor, let's assume that my credit spread is now at $50. I'm up $50. It feels good, but I still have like 20 days left. I'll move that stop loss up to break even. So which means that if the credit spread ever got back to $100, then I exit the trade. Also gets rid of the possibility of me losing money on this trade and maintains my P&L. This is actually one of the hardest things to do because psychologically speaking, and if you guys have traded even a little bit, you guys may understand this feeling. You have this feeling of euphoria because I'm making money, right? And then the moment it drops below break even, you might think, oh crap, I might need to sell. But because I was up on it, I'm not willing to take a loss. And so you hold that asset, you hold this option or you hold the stock, or hoping that it will go back above break even. But lo and behold, it sometimes never does, and you end up taking again a giant L. By moving my stop loss up from 100 to break even, I'm willing to not make any money, but I'm not willing to lose money. Now let's assume that this credit spread now is at $25. So you're up 75. Now in this case, you definitely don't want to lose any money here, right? Because you're already up so much money. So I'll move my stop loss from break even up to 50%. So which would be $50. The moment it breaks past 50%, then I lock in my profit and I make 50 bucks. Simple as that. And then you keep this going. It hits $12.50. Then you move it to 25% because every time it drops below 25, I'm not willing to lose the $75 profit that is currently unrealized. I'm going to realize it. I call this a dynamic stop loss. It's not really a trailing stop loss. It's just you keep moving it up as the market progresses, right? But you give yourself wiggle room so that you don't get stopped out too quickly. Initial open, you set your stop loss at 100% of your credit collected. If you want to set it at 50%, that's also completely fine. Just go from a range of 50 to 100%. Once it hits 50% in credit, you move it up to break even. Once it hits 25% in credit, move it up to 50. Once it hits 12.5% of credit, move it up to 25%. This way, you're continuously protecting your gains as the market progresses. And shortly later on in the next couple of sections, I'll show you guys how you guys can even refine this even further with technical analysis. But for beginners, this is actually a great way for you to quote unquote automate your spreads while you're doing something else. This is actually one of the strategies that I've been using when I'm not looking at the charts to keep things relatively passive. And just a caveat, right? You'll have some trades where you're up and you break even, you might feel bad. And there's certain trades where you stop out and the market reverses and you'll feel even worse. This is just to make sure, protect your P&L, to make sure you continue to win as often as you can and to lose as little as you can when you do lose. So now that we understand our stop loss strategy, we have to then learn how to exit these spreads. And we can do that by 1, closing out our spreads outright, or 2, rolling them and extending the lifetime of those spreads. So first, I'm just going to demonstrate how to close a spread. Let's take, for example, this UNH one that's up a decent amount. So we'll go in here, we'll click on it, and we'll go close position, right? Closing a position just means that I'm buying back the short leg and I'm selling the long leg, right? I'm basically doing the inverse of how I opened it. Now I have 12 in this account, and you can see the bid ask spread is around 27 to 40. I'll go to the mid price probably to get a good fill, and I'm just gonna submit sell order to close out this spread. You may have to tinker with the price a little bit. It's somewhere in between, but the worst you can do is 40 cents. The best you can do probably at this moment is 27. So let's take this one step further and show you how to roll a spread. Rolling by definition means that I am closing this current spread like we just talked about and opening up a new one at a later date. We're extending the time left on our spreads. So maybe instead of closing it, where we want to roll. So I have this TSM put right here, okay? So instead of closing it, I'm gonna click on rollover, and because it expires October 17th, 14 days out, I'm up like 75% on this. I want to roll it out. So I want to give myself a 2-week rollout. Let's keep it the same strike price, 260, 265. So we'll sell the 260 and we'll buy the 255. In this case, right, the bid ask spread is still relatively large, but I can probably get around 25 cents for this one roll. And this is what we call rolling out. We're keeping the same strike price, just extending the time. And this makes sense, right? Because there's more time on these options now, I should be getting a credit for it because of theta, right? There's more time on these contracts. Now, if I want to roll it down to a lower strike price, let's do 250, 255. So we're selling the 250 and we're buying the 245, sorry. And now we're rolling it down, so it seems like we're gonna have to pay money for this, a debit. Even though we have more time, we're now further out of the money, so we are reducing our risk to a certain extent. We're increasing our probability of profit. Therefore, we're going to receive less money for it, right? And in order for me to close out my initial spread and then open up a new spread at a later date, I'm going to spend more money closing out my existing one, less money collected when I open up the new one. So one last thing we can do, instead of rolling down, maybe we want to roll up because TSM has gone up in price point, which means that instead of selling it at 260, I want to sell maybe one for 270 and buying back the 265 leg as protection. Now, because we're rolling it up in strike prices, we're closer to the money and we're extending it out, we should be getting even more credit, right? And you can see that I'm potentially going to collect $64 or $65 of credit on this one roll. Now we have to understand when to roll. So the first one is the easiest to understand. Rolling is a great way for us to continuously compound and maximize the amount of credit that we're collecting. So my rule of thumb is usually this. Let's assume that we have like a 4-week spread around a 30 DTE, right? When there's 2 weeks left, 50% time remaining, I check to see if I have more or less than 75% of the credit already decayed out. Am I up 75%? If the answer is no, then I'm going to keep the spread and let it keep going. If the answer is yes, then I'm going to try and roll it. And usually in this case, I'm going to roll it up, right? Because this usually means that the stock has moved up, causing our spreads to be really far out of the money. Another checkpoint is when there's 25% left, or maybe in this case, 1 week left on the spread. Do I have around 90% decayed out? Again, if the answer is no, then I might leave it. If the answer is yes, then I'm definitely going to roll it out. The idea here is really simple, right? If I have 50% of the time left and I have only 25% left on my spreads in terms of profit, then I actually am being less efficient with time, right? I'm only going to make a quarter of the money in half the time. So I want to move on from that spread. Another way to look at it is because I've already decayed out 75% of the spread, I'm risking a lot of profit for very little reward, which would be a quarter of the total credit. Now, the reason why I don't set it at 50-50 is because if it's 14 days left, that's usually when theta is increasing, right? And so I actually have a better chance of making more money in the next 2 weeks because theta is now working in my favor. Again, I'm trying to squeeze as much money out of this as possible. Same thing with the 1 week left, right? Only have 10% left. Let's move on. Number 2 is when we want to defend a spread, which means that we are down on the spread. So according to our stop loss principle, let's just take, for example, the first stop loss of 100% of your total credit. Once it hits that, instead of closing it, you could potentially roll it out to a different date, right? You're extending the time frame of that spread to allow yourself more time to win. Let me give you an example by showing you the charts and the pricing so that you guys can kind of understand why this works. So we're going to do an example on the call side, actually, because we haven't done a lot of that. So in this case, let's say that NVIDIA is at 119.51, and I'm thinking of selling a call credit spread because I think the market might continue to go down. Fine. So let's just go to August 30th and find a credit spread. So August 30th, there's no probability of profit here, so I'm just going to estimate. I'm going to do 125, 130, because that gives me around 7 points, which is, I think, close to 80 or 70% probability of profit, give or take. So in this one case, this one spread, I'll be collecting $170 of credit. Now let's fast forward a couple days. Let's go to August 2nd just to see how it pans out. NVIDIA has dropped to 107, which means that my spread should be up, right? In 1 week, I'm now to $99. I'm up close to $70 on this one trade, close to half. Let's go forward one more week. NVIDIA is now at 106, so it's even further, and it dropped to 90, which means that, so now we're at 70. We're above 50%, so what do? We move our stop loss from what it was before to break even, which is 170. So on August 15th, NVIDIA has now shot back up, right? It's continued this upswing now to 119, very close to where we sold it for. Now it's basically back to where it was before, right? 162, basically 170. Let's assume that here you're thinking, let's hit our stop loss, let's roll it out. Let's give myself more time so that I can let this play out. So because there's only 2 weeks left and you're like, hey, I want to keep that same buffer, let's move it to September 20th, which is another 2.5 weeks. And this gives us $10 of credit. So it's 172, we were at 162. So by rolling it out, I'm collecting $10 and extending my time. So I'm adding to my funds. So now my total credit collected for this one trade is $172 instead of 162. That is usually how you would want to roll things out in terms of defense. But the next question that I get all the time is, why don't we roll it up or to a higher strike price to give yourself even more margin for error? And I'll show you exactly why. So if you go to 135, 130, now you're collecting 137, which means that when you roll this out, you're actually going to pay money to roll this out. So around $25 or so to give yourself more room, right? Just in case NVIDIA continues to go up. The reason why I don't like to do this is because now you're messing with your max profit and max loss, right? Your max profit looked a lot better before. It was 170. Now it's at 137. And there's no guarantee that you'll win in this trade because NVIDIA could continue to go up like it actually did, right? It went to 130. This is where the next rule comes in when it comes to rolling, is that I never roll if I can't get a credit for it. If I'm paying a debit, I'm never gonna do it because I would rather just close the spread out and move on. Well, let's continue talking about the topic of defense because I see that a lot in my comments when I post about credit spreads. There's another way of trading credit spreads where people break up the legs. So what that means is you have, for example, this 130, 135, right? Expiring at the same time. One person might end up extending this one leg, just the sold leg, so you can collect more money, while leaving the top leg, the protection leg, as stationary. A lot of ways to mess with these legs. And honestly, these are really advanced topics, really hard to do. But the reason that I don't really do this is because you're messing with your defined risk and defined loss, right? You know for a fact that when you're selling a credit spread, your max risk is your total credit collected subtracted by your width, right? That's my worst case scenario. By breaking up the legs, you're introducing a lot more risk, but because that 1 week, for example, where you have an unprotected put, if that stock continues to go against you, for example, in this case, like NVIDIA, where for demonstration purposes, it continues to go up to like 129, then you'll start introducing a lot more risk and you'll start losing more and more money, all because you're not willing to take the loss. So my rule of thumb, and I like to keep things as simple as possible because that's how you make things repeatable, is to just close out the spread whenever you hit your stop loss. I don't even like rolling a spread in this manner, like we're talking about right here, because it then just kind of delays the inevitable, especially on the call side. One thing I do want to touch on, it's about early assignment. When your short leg goes in the money, the option buyer has the right, by definition, to exercise that option, which means that you'll get assigned. So if you're on the put side, you'll buy 100 shares. On the call side, you'll sell 100 shares. That can happen at any time during the option contract. So that's why it's called early assignment, because it's not at the point of expiration. This is the in the money. This is the one option in the money situation that we talked about in the beginning of this video. And it's a real risk that happens. The first time it happened to me, I damn near lost my mind because I didn't really comprehend what was happening. My brain kind of just blanked out. My honest advice here is to just not deal with it, which means that if one leg of your option ever goes in the money, you close out that spread immediately. Don't risk it. If you follow the stop loss principle that we talked about earlier in this video, you should never have a leg that goes in the money. But if it does, do not risk it. Just close it. It's not worth the headache. It's not worth the stress of early assignment, because when it happens, it will be very stressful. And I would just recommend that you guys avoid this altogether. It's completely avoidable. It's much better to just take the loss and move on than it is to have to stress about it. In my more advanced strategies, I actually don't use delta in the same way that we did in the beginner strategy. And let me explain to you why, on both the put side and the call side. I can't actually find this article anymore. I reference this a lot, even in my other videos. I'm going to use one of my old videos. Tasty Trade actually did a study from 2005 to all the way to 2017, I believe. And they basically mapped out all the deltas on SPY using 45 days to expiry, and then measured what the actual percentages of it being in the money is. The overall takeaway here is on the put side, you can see a 15 delta should usually equate to a 15% probability in the money, but the call side is actually 19% and the put side is 8%. You see, same thing with 30, 40, and 50. The calls are much higher than the deltas by 4%, 10%, 10%, 13%. The further out of the money you are, the higher the percentage differences are. And on the put side, they're a lot lower, 20, 26, 37, than the actual delta. The explanation for this is actually really simple, right? During that time frame, S&P 500 And the overall market just in general has been in a general upswing, right? So it's more likely for your options that are out of the money on the put side to be out of the money at the time of expiration, and your calls to be in the money by the time of expiration, just because the market naturally goes up, right? This is just the natural flow of the market. And this is true for most situations. The first thing we'll talk about is on the put side. What you're actually seeing here is the market tends to overestimate the amount of risk associated with selling puts. And so this is actually one of the main reasons why I do not like selling calls, mainly because the market is underestimating the amount of risk that I'm taking on. I'll show you guys how I sell calls later on in this video, but this experiment demonstrates two things. One is if I'm selling puts, I can actually take on a lot more risk because the market technically always goes up, right? So I'm actually bumping my probability of profit further into the money. On the flip side, I don't sell calls very often because the market is underestimating risk, so I'm actually getting less reward for more risk, which ultimately means that your put credit spread should be your dominant player in generating income and generating gains, not your call side. The call side is very selective, and I'll show you exactly when to use them later on, which then leads me to, I guess, a more technical part of trading. So by learning how to trade with technical analysis, not only can I bump up my credit, I can also reduce that stop loss from the 50 to 100% that we said originally to something that's even less. So let me show you how to do that. First with TA, and this isn't going to be a masterclass of TA, but if you want to learn how to trade technical analysis, I made a 75-minute long video detailing everything there is to know about how to trade with TA. So make sure you guys check that out, linked in the upper right-hand corner right here. With this section, with technical analysis, I'm gonna try and keep it as simple as possible. Keep this in the back of your mind. One, we're trying to increase our win rate as much as possible. Two, we're trying to increase the credit we can receive. And three, we're trying to reduce the amount of risk or the downside that we have when we enter a spread. One of the best ways to use credit spreads as a way to trade momentum, which means that if it's in an upswing, right, it's going up, I want to trade up. If it's going down, I want to trade down. That sounds very obvious, right? And the easiest way to do that is to find stocks that are very predictable, right? So I like to call this predictability. So you head over to the charts and you can see what I mean. There are certain charts that have very clean looking charts where you can go and see like, yeah, it's obvious that this chart is in an upswing, it's going up, and it's obvious when things are going down. So if you look at this, the S&P 500, right? Generally speaking, it's very obvious to identify uptrends, right? Downtrends, uptrends, and downtrends. Take, for example, this upswing right here. I saw that there's a lot of buying power on this day right here on October 30th, 2023. So I decided to enter into a put credit spread. And if I had the simplest trading strategy, which is I sell credit spreads every single week with a trend for a month out, it's highly probable that you will win every single week until April 8th, even if you sold right at the money. That's around a 6-month win streak just by doing nothing but following the trend. However, if you didn't take into context the charts and you decided to short the market on August 30th and you sold out of the money every single week for a month out, you would have lost every single trade for that 6 months. So this is why you have to be able to, one, identify the trend, and two, be able to have a chart that's predictable enough for you to be able to ride that wave up until the music stops. And this is why we have to learn a little bit about technical analysis, because this allows us to find the right stocks to trade credit spreads on. So I'll give you another example. A lot of blue chip stocks are usually very predictable because they usually have high correlation with the S&P 500. So Microsoft is another one, right? You can see the chart's pretty relatively not volatile, pretty predictable. When it's in an upswing, you know it's an upswing. When it's in a downswing right here, you can see that it's in a downswing. Double top, ran on momentum, ran down, right? When it's now in an upswing, it's in an upswing. If you go to like Meta, it's the same exact thing, right? Pretty predictable. You go to Nvidia, also very predictable, upswing, downswing, upswing. Compare that to a stock like Tesla. Tesla is very hard to identify trends, right? Sometimes it's an upswing, sometimes it's a downswing. I can't really tell you which side of the trade to be on because the charts are kind of messy. This is what happens when there's a lot of volatility in the charts, right? It's very, very messy. And if you wanted to sell puts, you might lose. If you sell calls, you also might lose. It's just not very clean. And so I stay away from charts like this because it makes my life a lot more difficult, and especially for beginners. With this many swings, Your spreads will change pricing a lot week by week, right? And so you sometimes will be caught going, hey, should I exit? Should I not exit? Mainly because it's very hard to predict and you don't want to stress yourself out. You want to put yourself in those positions. So just stay away from charts that are not very predictable. So the next logical question is, how do we identify how predictable a stock is? And if you really want the whole story, go check out that masterclass that I'll link in the upper right-hand corner. But I'm going to give you guys the shortcut here. On my chart, I have the 20 period moving average, the one in yellow, 50 period moving average is the one in blue, 200 period moving average is the one in green. Keep in mind this chart right here, you can see how much the yellow one moves and the blue one moves. It goes from a negative slope to a positive slope to a negative slope to a positive slope. Kind of looks like a roller coaster, right? Same thing with the blue one. It's like a roller coaster. If you go to NVIDIA, you can see how less volatile the lines are. It's predominantly in an upswing going upwards with small downturns that are not as steep as Tesla, and then it goes back up. The blue line is always technically in an upswing. Next one is you go to TSMC, you can see the same thing, right? It's up, blue is up, never turn negative. The yellow, when it turns negative, it's not as sharp as the other one. And if you go to S&P 500, you can see the same thing, right? Now, if you want another example of high volatility, that's not a very clean stock, you can take a look at like AMD. AMD is very volatile, right? It goes up, it goes down, it goes up, it goes down. Like it's hard for you to trade this because you just don't know what side of the trade to be on. So avoid stocks that look like this. Find very stable moving averages to trade upwards. By doing this, you'll have a very high win rate. You'll keep winning until you don't, and that's fine. Okay, you can win 20 trades and then lose 2. You'll still come out ahead. The next concept I want to introduce is to help us increase the amount of credit that we collect when we do win. And there are certain situations where you can get a lot of credit for maybe even less risk. And I want to introduce this concept called volatility. I know we talked about volatility when we're choosing stocks, right? Some stocks are more volatile than others. You can see that in the charts that we just talked about. But this volatility on the stock also changes as stocks go up and down, right? As time goes on. We want to head over to Thinkorswim right now because Thinkorswim actually has a really good indicator for us to add that allows us to track implied volatility to show you how impactful this is. If you're on Thinkorswim, what you can do is you can go and chart out what the implied volatility is by looking for the implied volatility indicator and adding that to any one of these. And you'll see that pop up right now. And this is essentially what implied volatility looks like as stock markets or stocks go up or down. Implied volatility will also go up or down depending on price action. So one of the main things about IV to understand here is that when IV is high, your options are priced higher, right? You get more bang for your buck. But when IV is low, you get less money because the market is expecting less of a move. So in this case, for a specific stock, if an IV on a stock increases because volatility increases, for example, when it comes to earnings, and we'll talk about earnings in this video as well, then because the market is pricing in more of a move, your options are going to be more expensive. If there is like no volatility, then your options are going to be priced cheaper. So when you sell it, you won't get as much money. So a very simple concept here is theoretically, if we can track implied volatility, we want to sell it when implied volatility is high so that when the IV drops, even if there's no change in price, your option prices will drop, which means as option sellers will make money. A very simple action chart would be when IV is high, you want to be selling options, and when IV is low, you want to actually be buying options. Then if something were to happen, then your option prices will just increase in value. And so by looking just at the implied volatility chart, how do we know when these peaks will happen? Because we don't want to be selling here, we want to be selling here. But if you were to, for example, go all the way back here, how do I know that this is not going to be the peak and that this isn't going to continue to go up? I can tell you that there's actually a very relatively simple way to do so. So we're going to pull up implied volatility and we're going to look at price action. So let's just look at this one here because it's just easier to understand. So this one correlates to this candlestick right here. Oh, and what's special about this candlestick? Right, this is what the low previously was. So that's an area of support. Let's take a look at another one. Let's look at this one right here. Oh, this is potentially an area of support. Why? This is a 200-week moving average. It's an area of support. What about this little peak right here? Area of support, right? This is where it currently was, previously was. And what about this right here? It peaked right here, area of support. And it drops because the market went up. And what happened to this one? Oh, this is a potential area of resistance. And then let's look at another one. This one. Boom. What is this? Resistance, right? This is where this is the resistance where it was before. The market entered this level and they're like, hey, it might sell off. We can do the same exercise on S&P 500. You can do the same exercise on any other stock that you want. So you can see these peaks usually happen in areas of supports and resistances. So you can see that there is some correlation between areas of supports and resistances with increases in implied volatility. Now let's go back to the definition of implied volatility to understand why that is. IV is the market's prediction or expectation of how much a stock will move during a specific time. So when a stock enters these areas of supports and resistances, otherwise known as supply and demand, the market is expecting that there's going to be a larger move because that's an area where most people are going to be buying and selling their stocks. And you can see that it is often correlated with an increase in volume, which is an increase in activity. In general, we want to be selling in these areas of supports and resistances as credit spread traders because we can then crush IV. The strategy is actually called IV crushing. And it's very popular because when we're selling options, we want implied volatility to drop, which means that it not only increases the amount of credit that we collect, but it also increases our chances of winning because it decreases our risk. So we're gonna jump back to the charts and we're gonna go back to the daily view. So let's assume that you had the wherewithal on this day right here, which is August 5th, to want to sell a credit spread because why? It's entered this area of support again, right? Which you saw on April 25th, 1, 2, and now it's re-entered this area. And so on August 5th, you're like, hey, I want to maybe potentially enter a trade. So we're going to August 5th, which is a Monday. And we're going to look, and we'll jump to later in the afternoon so we can take a look at the price action. And we're going to drop it down to the 30 minutes. Let's assume here, 11:30. So we'll drop back to 11:30 that we were able to pick up that spike on volatility right here. Volatility is at 38%. We're at 394.66. So let's assume here on this day that we're going to trade, we'll do the 18 day out one. Let's just actually sell this in the money, just to demonstrate, right? We'll go to 395 here. So you're making around $250 on this trade, which is pretty good, as you would expect for being in the money. Let's jump forward one day, because we know the next day the market actually went up. So we'll go to the 6th at 11:30. We'll jump over to the chart just to double check. And you can see implied volatility gets crushed. We're at 0.29. It was at 394 before. Now we're at 404. And take a look at the pricing. We're at 162 now. I went from 250 to 162. You can see by having this stock move in the right direction alongside with implied volatility getting crushed, you made almost $100 per spread on this one day. And that's not even the best part. Let me show you what happens when IV gets crushed and the stock actually moves against you. This is actually one of my favorite strategies, my favorite ways to sell credit spreads. On this day, on 7:30, volatility spiked and it subsequently dropped. And the reason we want to look at this one is because if you zoom in here, volatility dropped while stock price actually ended up lower. So what we're going to do is we'll go to on demand on Thinkorswim, and we're going to look at the historical pricing for a credit spread on July 30th and July 31st. So we'll go to July 30th here, and we're going to look at it at 10 a.m. And I'll show you why. And we're going to drop it down to 30 minutes. This implied volatility chart will work on any time frame. And just to reiterate, right, it enters a level of support, it spikes, enters a level of support, it spikes, enters a level of support, which we're in, it will spike. So let's assume that at 10 a.m., this is where it re-entered this level of support. It hit the 417 low of the previous couple of days, and you're like, hey, I want to trade this area of support because I like the price action. And on top of that, volatility has peaked again at the same level as it was before. I think this might be a good trade. So we'll go to trade. And just for simplicity's sake, we're going to look for something a little bit closer. So let's just do the August 16th. And we're going to choose something relatively aggressive, right? We're at 418. Let's just do 410 for demonstration purposes. For this one, you'll collect around $190 for around 2.5 weeks. Remember, implied volatility is really high. It's at 38.34%. In around 2 weeks, you can get around 70% ROI on this credit spread. Microsoft only has to drop 8 points and see what happens. So we're going to move forward one day to July 31st, and we're going to take a look at the chart. So remember, at 10 a.m., it's at the low of the day again. It's around 414 and 55 cents. So Microsoft actually lost 4 points in value. But what you will see is this day right here, implied volatility plummeted from 33 all the way down to 25. So we lost 3 points, but look at our option pricing. We actually end up making money. We're up $20 on this trade, even though Microsoft fell by 4 points because implied volatility went from almost 40 to 25%. So let's do the same example. Let's just go up one spread to 405, 400, just for another example. We're still really aggressive, right? We're at $162 a spread. Let's move it forward one day and see what happens. It's at 132 now. So we dropped another $30, even though Microsoft fell by 4 points. And let me explain briefly what just happened. IV is the market's anticipation or expectation of how much the underlying stock should move. And so if it doesn't move as much, even if it moves against you, you're actually win on your trade as an option seller because the option price should decrease. The only real time you can lose in that situation is if the actual volatility is higher than what implied volatility is projecting and the stock moves against you. The market anticipated, for example, a 5-point move, but the market only moved 2 points. This is one of my favorite ways to trade credit spreads. And this kind of leads us to a perfect segue into earnings. Because during earnings, IV actually spikes a lot. So selling into earnings is actually a mixed bag. Some people love it, some people hate it. Personally speaking, I actually don't mind it. There's actually empirical evidence that has proven that the market tends to overestimate volatility during earnings. There's this paper about how option pricing fluctuates around earning announcements. One of the largest takeaways for this is the market tends to overestimate volatility when it comes into these significant events such as earnings. My favorite way to sell earnings is actually when stocks are in these area supports, like we just saw with that same example. So the reason I love selling credit spreads during earnings when it's around these areas of support is because from a technical perspective, there's a higher likelihood that buyers will step in and push the price up, especially if earnings isn't as bad as expected. And even if earnings was worse than anticipated, there could still be people that step in and buy. That support will often absorb the move. I'm relying on market structure to help me as well. So the last caveat here is when I'm selling credit spreads, I like to open up credit spreads the week of earnings for 4 weeks out. However, I do not like leaving my options during earnings. I only open up credit spreads. I close my credit spreads when they're the week of earnings because I can't absorb the volatility. I don't sell credit spreads hoping for a drop in volatility. I sell them where I believe buyers are waiting. That's essentially what trading with structure, trading with technical analysis helps us do and helps us refine our edge and push up that win rate even more. And I want to demonstrate how I apply these principles, these technical analysis principles, into my own trading. So the first thing I want to kind of touch on here is, as you can see from my trades, all of these are put credit spreads. Not a single one of these trades here is a call credit spread. And I kind of alluded to this early on in the video where I said I don't like trading calls. I would much rather just be trading the trend, which in most cases is going to be an uptrend, hence why we sell put credit spreads in most situations. However, there are two very specific situations where I sell calls. So let's touch briefly on them. The main one is when the trend is down. So as you can kind of see, and this is just the S&P 500, you can see most of the time the market's in an uptrend, right? I don't want to beat that horse to death. But there are times where the market pulls back, right? Here, here, here. And these pullbacks are usually pretty quick. So from that, you can tell, one, I have to be able to identify when the trend turns negative. And two, I have to be able to get out pretty quickly because the downtrend usually moving a lot faster than the uptrend. So this is where technical analysis really comes in. It's where you have to understand a little bit about how market moves to be able to kind of time these trades. And this is why call credit spreads is a lot harder because it's a lot less forgiving. And so I'll give you guys a quick example. I'm not going to go through a whole TA course. Again, if you guys want to check out how to trade using TA to find more of these trades, link in the upper right hand corner like it was before. One of the main drivers of TA is to look at candlestick patterns. Is there a pattern that will allow me to enter on the bear side where it shows weakness? For example, right here, this is a very bearish signal, right? A market goes up and it had a bearish engulfing candlestick. So on this candlestick open, I probably sell a call spread. I would enter the trade right here at 45.40. And then I would basically get out when it gets to 4,000. Maybe I might write it down to 3,500. But because this is a 20 period moving average and it has historically respected the 20 period moving average as support, I probably wouldn't take more risk on and wait until it falls all the way down to here. Another one is right here, and this is what we would call a evening star pattern. So on this candlestick break right here, once it breaks past this low at 57.50, I would then enter a trade on the call side and again write it down to 5,300. And the main difference here is I would probably just take profit the moment it hits 5,300 because I'm not sure if the market's going to rebound there or not. Because it moves so much quicker, I need to spend less time in the trade. So I'm going to take the win and get out. Now, the second situation is when I already have an existing put credit spread and I want to sell a call credit spread on top of it. This is what we call an iron condor. The reason that iron condors are so popular is because if you sell it for the same date, you can't risk more money. So for example, if I go to TSMC, if I give you an example, let's go to TSMC, and I, for example, have a 270, 265 put credit spread. I'm risking maybe $400 on this trade. And at the same time, I open up a 300, 305 credit spread for the same date. I collect the same $100. And so I'm also risking $400 on this call credit spread. If I open them separately, I will be at a $400 risk and a $400 risk and a $100 profit and a $100 profit on both. But if I open them together, since they expire at the same time, my profit potential is now $200. So my risk is now at $300. And the reason for that is very simple. The market can't both be above the call credit spread and be below the put credit spread at the same time. So the worst case scenario is I only lose on one leg. Quote unquote, risk to reward is lower. Now, for me, I don't necessarily agree with that, mainly because if I sell a call credit spread and the market's in an uptrend, it's likelier that I'm going to lose on the call credit spread than I am on the put credit spread. So that loss, let's assume that's $50 on the call side, and I'm still only collecting 100 on the put side. That means that I actually end up only making $50 overall when I could have just made $100 by not opening up the call credit spread. However, that doesn't mean that I don't open up iron condors. I do it at a very specific time. And so what I like to do is I like to open up a put credit spread first. And once my put credit spread is decaying out, right, the market has moved up, then I like to sell a call credit spread maybe 14 days into the put credit spread lifetime. So let's just take this example right here. This one candlestick is a month. So let's assume that I take candlestick open as when I open up my put credit spread. So I have 185, 180. As the market moved up, let's assume it moved up to 220. My put credit spread is basically all decayed out and we have 2 weeks left. And so let's assume that I think that the market might have a chance of going down on this candle. So I would then sell a call credit spread above that, let's say 230, 235, to try and add on maybe another $50. So I collected $100 down here and I'm trying to win on an extra $50. With 14 days left, the market then comes back down to 208, and then I win on both legs, 100 and 50 for both the put and the call. So I collect 150 total. And you can see why I like doing it this way. Because as the market's moved up, I'm basically guaranteed to win on the put side to a certain extent, right? And then on the call side, I actually don't like to be very aggressive because I don't want to lose money on the call spread, right? I just want to make a little bit more money. So I tend to be very conservative when selling it. If and when I win on that, then I increase my profit from 100 to 150. So that's just how I like to sell iron condors because it gives me a better chance to win on both sides, right? My call strike price, it'd be a lot higher than what it was if TSM was at 185 and I had to open it up like an 80 or 90 delta, and which would be like 200 and 205. I'm able to open up at 230, which gives me a lot more margin for error. Okay, so let's now then finally wrap this all up, and I'll give you guys a couple examples of my real life trades, how I apply TA, how I apply these concepts to collect that $45,000. So if you see from this dashboard right here, you can see that my P&L is $43,000. I win at a 94% clip, lost my first trade, but I won on every other single one. Nothing spectacular. I'm just following the trend, as you'll see later. My average win is $2,600. My average loss is $1,900. You can see how my average loss is less than my average win. Capture just means how much of the premium am I capturing. And so I've captured 90% of all the premium. So if I have a $100 credit, then I'm profiting $89 every single trade on average, which means you can see that I've taken some 75% stop losses. I don't maximize all of my profit. I've rolled some out as I decayed out, like we talked about earlier on in this video. My profit to risk is around 41%, which means I'm making 40% return on my risk every time I win. And then my average time in the trade is around 22 days. It's around 3 weeks, which means that it's less than the 4-week DTs I'm opening, right? You can see that how like I'm rolling it and I'm closing it much more aggressively. And this is why you see it compound a lot more, because I'm being more time efficient with my money. Again, you can see this. I have $21,000 in open premium, which is actually my total risk because I'm only going to risk how much I can make. But my open risk, if I didn't have any stop loss management, is around $78,000. But my actual risk is only around $21,000 because, again, my premium is only $21,000. So you can see I'm significantly less than 5%. I'm even at like 4 or 3% at the very moment. And let me know down in the comment section below if you find dashboards like this very helpful. I can talk more about it or give you guys more insights into the metrics in here. So what I want to do now is I want to take you guys into just a couple of my trades. You can see that I'm not trading too many tickers. I'm really only trading 4 tickers. So let's just go to Lockheed Martin because that's one of my more widely traded ones. So you guys can see how this panned out. So one thing you'll notice, right, is Lockheed Martin's chart is very, very, very stable, right? Very predictable. Up, down, right? These 200 period moving averages always act as support historically speaking. The slopes on these 20, 50, and 200 period moving average are just sloping up. It rarely ever slopes down. Number 2 is as it falls into these 200 period moving averages, so the volatility will rise. So what I want to do is I want to be selling at this level right here. So my first trade on Lockheed Martin was at 728. So let's go back to the week real quick so I can show you 728. So you can see 728 is this week right here, right? As it fell into this area of support right here, I decided to start selling credit spreads for this experiment. And can you see how like simple it was? As it went in, every single week or every other week, I just started selling credit spreads as the market moved up. And at some point in time, I will lose, right? I will hit 50% of my credit collected and I will stop out. But the beauty of that is that I'll lose maybe $2,000 or $1,500, but I've already collected a total of $12,000 of like realized profit. So even if I lose $1,200 or $1,500, so be it, right? I'm still up a lot. And that's the beauty of finding stocks that are very predictable, because as it bounced off of the 200 period moving average right here, we can just ride this wave up. And this candlestick may very well continue to go up. And if it continues to go up, I just continue to keep selling it until the market tells me to stop. I'll talk about UNH briefly as well. UNH is the same idea. It fell into this 200 period moving average. You can see how I'm just repeating it. Historically speaking, UNH has been very, very stable. It just recently, because of all the controversies, that it isn't. So my first trade was July 8th. As it entered into this area of potential support, the market continued to go down, so I lost on it. Fine, I got out. You see me cut my losses. Hopefully that shows you that you just got to cut your losses. And then I waited for a little bit, and the market then fell further into this 200 period moving average, and then it started rebounding. And again, you can see how simple it is. It started rebounding, and I just took advantage of this ride up. And ever since then, I've just been selling credit spreads every single week or every other week, and I rode the wave up. And at some point in time, again, like Lockheed Martin, I will lose. I'll lose again 50% of whatever credit I collected. I'll take the loss, and I'll just wait to see whether or not UNH is still a stock that I want to continue trading. And ideally speaking, if UNH continues to go up, then I just keep trading it until the market tells me that I can't. Simple as that. So hopefully with those two examples, you can see how combining technical analysis with a good understanding of credit spreads, you can see how stable and how passive it can be. You don't have to overanalyze charts. You don't have to overanalyze concepts. You basically just ride the momentum and you volatility crush. There's a little bit more here that we can talk about in other like more advanced videos if you want, but this is essentially the strategy. Areas here are much less risky. Areas up here are a lot more risky for the put side. But then once it gets to an area of resistance, then I can start maybe selling calls and potentially predict that downtrend. So let me know down in the comment section below if you have any questions about what I did, but hopefully that's a good experiment for you to understand how to trade credit spreads and how these principles work in live trading scenarios. And on top of that, if you guys want to see like additional examples going forward, or if you guys want to see a live series of me trading credit spreads, let me know down in the comment section below and I'll see what I can do. So let's talk a little bit about risk management. We're going to start off with account allocation. When we're trading credit spreads, we do not want to use 100% of our account to trade credit spreads. I know it can be tempting, right? Because you think you can't lose, right? You're winning a lot all the time. So a lot of us will think, what's the risk? And trust me, I used to use a lot of my account all in credit spreads. It's because this is your whole account. Your emotions take over and you tend not to be able to follow your rules because of the stress, right? You're seeing your account move by 10, 20% a day, either up or down. So you get greedy and you get fearful and you act irrationally. And this is how you blow up accounts. Exactly what happened to me back in 2018 when Trump announced his first rounds of tariffs. I blew up that account because I had no risk management skills. So what we should be doing with credit spreads is we're allocating a small portion of our account. My general rule of thumb is do not use more than 20% of your account in credit spreads. So as you can see from the credit spreads that I sold using one of my larger accounts, I'm really only using around 7 to 8% of my total account. My allowance is around 10%, so which means that I can actually trade more spreads. For context, that counts $700,000, so I have around $70,000 of cash to trade. But at any one point, I'm really only around 5 to 6% of my total account, which means I'm only trading around $35,000 to $40,000 in credit spreads at any one time. But even if I'm only using 5 to 7% of my account, you can see how much money I made over a span of 2 months. And that's the impressive things about the strategy is you don't actually need that much money to make large returns. And so let's just do some simple math. Let's assume that I'm returning maybe 30% a year, which is amazing. The rest of the account, let's assume it's just an S&P 500. You blend 10% of your account at 30% and then 90% at 10%, and you'll get an annualized return around 12%. That's incredible because you're using credit spreads to continuously compound and increase the overall returns of your portfolio. And the reason I trade this way is obviously based on our past experiences, also because advanced strategies like this is hard, right? And it's risky. And so you do not want to be over encumbered on a riskier strategy, right? Make sure that most of your money is still in safe stuff and use the riskier options to make more money. That's it. Which leads us to number 2, trade management. How much am I willing to risk per trade? My rule of thumb is I'm never usually willing to risk more than 2.5% per trade, which means that I am allowed to lose 40 trades in a row before I blow up my allowance. If you look at my spreads, if I allow for a 50% drawdown or 100% drawdown, and I'm collecting $2,000 of credit, then my max loss is going to be $2,000. That's how much I'm willing to risk. $2,000 divided by $70,000 is around 2.5%. I'm only collecting $2,000, $3,000 every trade. That's what my risk is allowing me to do. Do not trade to profit, trade to risk. So do not over-index again, all in on one trade. Because I know we all want to make a lot of money all at once, but we have to think of the worst case scenario. If we lose on that trade, let's assume we lose 100%, we risk everything, then we're done. We can't trade anymore. And that is actually one of the biggest reasons as to why traders fail. And because you watch this channel, you know how to manage those risks. Again, do not risk more than 2.5% per trade. Make sure you guys are able to survive when things do not go according to plan, because they will not go according to plan all the time. So this might be a little bit more challenging for smaller accounts, but let's walk through it. It's actually not that complicated. Let's assume that you have a small account of maybe like $5,000, and we're not going to use more than 20% of our account to trade credit spreads, which means that we have around $1,000 to trade credit spreads. And at any one time, right, we're not risking more than 2.5% of our account, which means we're not going to risk more than $125 per trade. Remember, we're trading to risk, not to profit, which allows me to lose at least 8 times before I run out of money to trade credit spreads with. And so let's just run through one example. Let's assume that my stop loss is going to be 100%. That means I can collect one credit spread and get $125. That's the credit that I'm going to try and aim for. If my stop loss is 50%, I can sell 2 of those credit spreads. On that one set of trade, I'm only going to risk 125 because my max drawdown per trade is 50%, which is going to be $61-ish. So you can see how scalable it is. Once you start winning on credit spreads, you'll see your account get bigger and bigger and bigger. And then you can start selling 3, selling 4, selling 5 credit spreads. So when I first started my account maybe 8 years ago, I was trading 1, 2, 3, 4, 5 spreads. Now I'm trading 30. That's the amazing part about these option strategy is that as your account scales, right, you keep those same rules, 2.5%, 20% of your account. You start trading more quantities to keep the same proportion. That's how you make sure you do not blow up your account on one bad trade. Always give yourself a fighting chance. And the same is true for small accounts. And you'll see that small account won't be so small if you keep this up. So we've gone through a lot in this video, right? All the basics, the more advanced strategy, the psychological part of trading, how to manage your accounts. We've gone through a lot. If you guys appreciate content like this, make sure you guys like the video and subscribe to the channel. It'll really help me out. I always get some questions on taxes, so let's talk a little bit about it. Credit spreads is a short-term option strategy, especially the way we're selling it. So there's no inherent tax benefits. All of these are going to be short-term gains. So the only thing I can say is you make money, make sure you guys leave some money on the side to pay off your taxes. That's really all there is to it. Now let's talk a little bit about how to get started, right? Because I think a lot of us, you'll find credit spreads may be a little daunting. So let's go through how to start. When I first started, I started with paper trading, right? I'm using fake money to practice. I would recommend that everyone start with paper trading, mainly because credit spreads can be a little bit complicated, right? You have to understand how the mechanics works, right? There's a lot to learn, a lot to understand. But more importantly, you have to paper trade like it's real money. Because the most important part, hopefully you guys understand from this video, is the psychological part. Are you able to follow these rules? Are you able to trust the process? I know from personal experience that when I first started paper trading, I wasn't trading in like real money. I didn't feel real connection to it. So when I cut, I cut. When I won, right? It didn't really impact me anyway. And so when I graduated to real trading, I wasn't ready for the emotional toll that losing money had on me. That loss aversion was so much stronger when I was trading for real than it was when I was paper trading. So when you're paper trading, when you're practicing, you have to pretend that it's real, or else you're not getting the right practice in. And number 2 tip is that credit spreads and option trading is hard. So be kinder to yourself, because you guys are spending the time and effort to learn a new skill, and it will take time and effort to learn it. That the more you practice, the more you learn, the better you'll get at it. And sooner or later, you guys will develop your own style that will be different than what you guys see here on this video. And that's completely fine. What is important is that you guys find a style that works for you and your lifestyle and your situation. Because the way I trade is what came out from me having to work a 9 to 5, from my own personality and my own risk aversion. Right? This is how I trade. Modify it, change it, make it your own. And that's how you guys are going to be even better than I am. Account requirements. What do you need in order to sell credit spreads? So the first thing you guys have to do is that you guys have to apply for options permission. Every brokerage is slightly different with their requirements, but generally speaking, you need to get a higher level permission. So for example, on Fidelity, Tier 1 does not allow you to sell credit spreads, but Tier 2 allows you to sell spreads up to 4 legs. So perfect. You can sell a put credit spread and a call credit spread, iron condor this. It's great. Tier 3 usually has more margin involved, selling uncovered calls and puts. So you really only need option 2 for Fidelity. They have 4 option levels. For IBKR, you'll probably have to be at level 3. You need the short call spread and short put spread. And if you go to Robinhood, if you can see from my screen, in order for me to trade spreads, I need to switch to a margin account, which will allow me to access level 3 options trading, which is what I would need in order to sell calls and put spreads. Just check what your brokerage requirements are, apply for the correct level that allows you to sell credit spreads. We've gone to the end of the video. Hope you guys learned a lot. Hope you guys have a better and robust understanding of what credit spreads are. I'm just really just going to talk to the camera now and give you guys a little bit of my experience so that you guys can hopefully refer back to this video and this section to be like, hey, yeah, I'm experiencing that as well. And hopefully this will help you along in your journey on selling credit spreads. First things first, like I said in the beginner video, trading credit spreads is difficult. It is a form of trading. Okay, you'll have really high highs and you have really, really low lows. So the first and probably most important tip, you guys haven't already inferred it from this video, is that emotional control is the most important thing. We have to be able to learn how to control our emotions so that we can stick to our plan. And there's another theory called hot hand fallacy. And this happened to me as well, where you win 10 trades in a row, or you win 10 hands in a row at poker, and you think you're on a streak. So the next hand you size up. So instead of 2.5%, you go up to 10%. And then you lose the next trade, which then leads to the next emotion that comes very often, which is revenge trading. You take a large L and you go, I want to make that money back. So you enter an ill-advised trade, you take more risk on, and you lose that one as well, right? You can see how the cycle repeats itself. And all of this happens because you can't control your emotions. On the flip side, there's also going to be time where you don't want to lose money. Trust me, I've been there, right? Because it hurts, it sucks, right? It's real money. You've worked hard for that money. On top of that, you may not want to cut your trade because you think there's more room to run, right? It hits your stop loss of 50%, but you're like, hey, I was up 75% earlier. I want to get back up there. So you don't want to cut because that perceived motion of losing unrealized gains hurts. Fear and greed will dictate a lot of your actions. Make sure you guys do your best to tune those out. Which leads me to number 2. The best losers are the best winners. Comparing myself now to where I was 4 years ago, I don't necessarily think my understanding of credit spreads is that much better. Sure, I've learned a lot more over the last 4 years or 5 years, but the main difference is that I'm now a much better loser. Back then, I couldn't lose. I hated losing. The loss is gnawed at me, right? But now I take the loss and I move on. If you guys are able to develop this muscle, to develop this skill, you'll be successful regardless of what you're trading. It doesn't matter if it's leaps, credit spreads, debit spreads. And if you guys want more information on how I trade leaps, you guys want more information on how I day trade, let me know down in the comment section below, which leads us to the third tip. You do not need to overreach for gains. If you trade the right way, if you follow a plan, if you make a plan and tailor it towards what you like to do, you'll be successful in the long run as long as you play the probabilities. Think about it this way. I might average on one trade 20% return. S&P 500 on average averages 10% a year. So on one trade, you're already doing better than the S&P 500. 20% annualized is 240%. That is better than any hedge fund out in the market right now. So if you're able to do like 30%, 40% a year, dude, you're amazing. You're doing great. As long as you're trading well, the gains will come. Simple as that. Don't reach. The next one, like I said in the beginning of the video, be kind to yourself. Learning how to trade credit spreads or learning how to trade in general is very difficult. You're going to make mistakes. You're going to lose some money. You might make a lot of money, but make sure you guys take the time to congratulate yourselves, right? Once you open your first credit spread, let me know down in the comment section below. I want to know, right? Because you guys are taking the time to learn a new skill, and that's very, very admirable. Be kind to yourself because you will make mistakes. Mistakes are allowed. They're okay. I've made many throughout my trading career, and I can tell you so many stories that you'll probably get very bored of them. And the next one, which is probably the most important tip if you want to improve, which is you guys have to journal. Write down all your trades. Make sure you guys are tracking what you are learning, what you're not doing well, what you are doing well. This channel actually started as a way for me to journal, video journaling, but obviously it's grown a lot more than that. But journaling is really how you improve. Make sure you guys journal. Make sure you guys track those trades so that you guys can not make the same mistakes over and over and over again. And lastly, don't compare yourself to others. You only have to compare yourself to yourself. Everybody is at a different part in their life. Everyone's situation is different. If you guys are comparing yourself to me, it may not be a fair comparison because I've been doing this for much longer than you. Comparison is a thief of joy. Don't do it. Thanks for listening to me ramble. Let me know if you guys have any comments or questions down in the comments section below. If you guys enjoyed the content, I would really appreciate it if you guys like the video and then subscribe to the channel. I'm on a mission to really put out the best content out there so that people can make a change in their life. Options has done really well for me. Learning how to invest has really impacted my life. I can't imagine where I would be without it. If you guys want to learn how to sell puts, much easier. I made a masterclass. I'll link in the end screen right here. If you guys want to learn more about TA, I'll also link it in the end screen right here. Until next time, stay safe. Wish you guys all the best. Peace.